Hello, I am Vadini Arya. This is lecture 2 of my online course, Control Accounts in Bookkeeping. A control account is used to check the accuracy of the postings to a particular ledger account. The term self-balancing refers to the inclusion of a control account generally kept at the front or back of the ledger and used by the accounting staff on the total balances extracted from the ledger. In addition to check the bookkeeper's work, this system is also used for internal audit purposes. When the auditors come to check the accounts, the auditors, they have internal and external auditors. It's used by the internal auditors. They check the accounts very often, but the external auditors, they come once a year mostly. Control accounts are general ledger accounts that summarize a large number of transactions. As such, they are part of the double entry system they use to prove the accuracy of the ledger accounting system. They use primarily concerning receivables and payables balances. The common types of control accounts are accounts receivable and payable. Account payable. Accounts receivable are usually maintained when you sell goods on credit for the amount due from the debtors. In the same way, the accounts payable is the amount that you owe to the suppliers. You can also use a stock control account to summarize the transactions in the inventory and the stock. This purchases. The ledger account, this particular control account is used when you buy the goods on credit. Sales ledger. When you sell goods, you will raise in the invoices for your records. Those invoices are entered in the ledger, sales ledger, as a third party. And when you receive payments from the customer, you will credit the sales ledger and debit the bank account. Thereby, it will show that there is no outstanding debt owed to you. If you have not received the money when you are closing the report for the month, the balance on the sales ledger will show as debtors control account. The balance on the debtors control account will add to the assets account in the balance sheet. It's one of the current assets. Purchase ledger. When purchases made by the business receive invoices and those recorded in books called purchase ledger. Companies maintain a double entry system unless it is a tiny business. Therefore, the debit entry entered in the purchase ledger, cancelling the original entry when received from the supplier. If you have not made the payment by the end of the month, the balance on the purchase ledger will show as a credit balance on the creditors' control accounts. That balance added to the liabilities in the balance sheet. Liabilities, normally they ask for liabilities within a year. So you can put that amount in the balance sheet. The purpose of the control account is to keep the general ledger nice and clean without any details. It contains the correct balances to use in the financial statements. Many of the reports seen in the financial statements take cash, for instance, shown as the control account in the balance sheet. The book and credited to the name of the supplier's account. Purchase day book. If value-added tax is applicable, a different column is needed in the purchase day book. Therefore, the above entries are made in the books to maintain the correct transactions, to avoid errors such as duplicate payments, overpayments, and missing payments. If you miss the payments, the owner of the business will get into trouble. And if you make overpayments, the cash flow will be affected, and duplicate payments also the cash flow will be affected. Do you like this lecture? Do you understand it? I hope you understood it. Practice it, read and practice it. Thank you very much for watching my video. Thank you. I'll see you in the next lecture. Thank you.